This is an Uncovered Japan company research report on Nippon Ceramic, ticker 6929. It is a Totori-based electronic components maker that has built an estimated 60% share of the global infrared sensor market. The question for investors is whether that specialist position, a high-yield capital return profile, and a new midterm plan justify the valuation and the risks that come with a narrow product niche. At the report's reference point, Nippon Ceramic traded on a forward PE of 17.2 times, with a 4.23% dividend yield. Return on equity was 14.4%, and the equity ratio was 84.6%. That is a strong financial profile, but the shares were above the company's recurring profit median multiple, so this is a quality at a fair price case rather than a simple bargain screen. Nippon Ceramic makes ceramic pyroelectric infrared sensors and related modules. These are small components, but they perform useful sensing tasks. They can detect people or heat in a vehicle, a security camera, a video doorbell, motion-sensitive lighting, or industrial equipment. The business is best understood through four end markets. Automotive is estimated at about 40% of sales, security and lighting, each about a quarter, and semiconductor production equipment, roughly 10%. The mix matters because the largest exposures are not all driven by the same demand cycle. Automotive benefits from advanced driver assistance safety requirements and more sensors per vehicle. Security benefits from smart cameras, doorbells, and monitoring demand. Lighting and appliances provide a mature cash base, while semiconductor equipment flame sensing is the cyclical option. The report treats the end market splits and margins as directional estimates because the company discloses one accounting segment. Over the 5 years through fiscal 2025, revenue grew from 17.1 billion yen to 27.3 billion yen, a compound annual rate of 9.8%. Operating profit grew faster, from 2.85 billion yen to 6.23 billion yen, a 17% compound rate. That lifted the operating margin from 16.6% to 22.8%, a key sign that scale and operating leverage have been working. This chart also shows why reported net income needs care. Operating profit increased steadily across the period, but net income jumped in fiscal 2022 and fiscal 2025 because of one-off gains related to Chinese subsidiary events. For the underlying business, operating profit and recurring profit are more useful anchors than headline net income. That distinction is particularly important when looking at historical PE multiples. Operating cash flow ranged from roughly 2.9 to 6.5 billion yen across the disclosed years, and free cash flow stayed positive. Combined with no debt, an 84.6% equity ratio, and approximately 30 billion yen of net cash, the balance sheet gives management options. It can fund capacity, sustain dividends, buy back shares, or pursue new product areas. The key investor question is whether that cash continues to be converted into per-share value. The core moat is not a household brand or a single patent. It is cost per unit at scale. Nippon Ceramic's estimated 60% global share lets it spread fixed costs across a large volume in a niche market. Vertical integration, including materials, assembly, testing, and automation, reinforces that advantage. The market is meaningful to a specialist, but small enough that a much larger components maker may not find a direct attack economically attractive. The new midterm plan points to 30 billion yen of revenue and a 23.8% operating margin, alongside an ROE target above 12%. A Philippine plant and more automation are important to the capacity and cost case. The offsetting risks are equally concrete. Chinese vehicle makers are localizing procurement. A single distributor called Chugai accounts for about 22% of sales, and the company remains concentrated in one broad sensor technology. Against selected sensor and electronic component peers, Nippon Ceramic's 17.2 times forward earnings multiple sits near the lower end of the sector's roughly 20 to 25 times range. Its dividend yield and return profile are stronger than many peers. The counterweight is that the shares trade at 1.84 times book value and above the company's recurring profit median PE, so the quality premium is already partly recognized. The report's 3-year scenario framework runs from roughly 2,800 yen in the bear case to 4,200 yen in the base case and 6,000 yen in the bull case, versus the report's reference price of 3,900 yen. These are the author's illustrative scenarios, not price targets. They hinge on revenue, margin, and valuation assumptions, with the most important swing factors being Chinese localization, the Philippine ramp, capital allocation, and new automotive customer wins. Nippon Ceramic combines a specialist sensor position, expanding operating margins, a debt-free balance sheet, and a sector-leading yield. The report's scorecard is 14 out of 20, with growth, value, and macro fit offset by a weaker supply and demand score. The case ultimately turns on whether management can keep translating its cash, capacity, and scale advantage into per-share value while protecting the niche against localization and concentration risk. This has been research, not investment advice. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.